A casino is honest. They show you the odds. Prop firms show you a dream. You see the TikToks, the rented Lambos, the teenagers claiming they cracked the code. But 93% of these traders never see a payout. They aren't customers, they're fuel. It's called gambler's ruin, a statistical certainty that if you play long enough, you hit zero. Level 1, the challenge. You pay $500 for a 100K account, but the money isn't real. It's a simulation, a paper trading environment designed to feel like the big leagues. You feel the rush, the dopamine hit of a green candle. You think you're in control, but you don't own the assets. You don't even own the data. You own a ticket to a rigged game. The firms don't make money from your trades. They make money from your failure. Every time you hit reset, they collect a fee. Your frustration is their primary revenue. They use the 7% who win as marketing bait, the proof of life for the delusional. They want you to see the winner so you ignore the graveyard of blown accounts. Prop trading isn't an industry, it's a volume business. They need your attempt. The rules are the cage, drawdown limits that trigger exactly when volatility hits. They know your psychology better than you do. They wait for the revenge trade. One mistake, one news event, one spike in the spread, and your account is gone. No mercy, no margin call, just a cold email saying, "Challenge failed." You feel the sting, the urge to get it back. That's the moment they own you. You pay again, another $500, another dream. The cycle repeats. It's a $12 billion industry built on hope, but hope isn't a strategy, it's a tax. The firms are hedge funds, but they aren't hedging stocks, they are hedging you. They know the math, they know the win rate, they've priced your failure into their Q4. So why is it so popular? Because social media creates a false sense of proximity. You see someone who looks like you, making money that looks like freedom. But the tuxedo is rented, the cash is a simulation, the freedom is a lie. In the US, prop trading has replaced the lottery. It's the new blue-collar dream. But at least the lottery doesn't make you work 14 hours a day to lose your money. You're an unpaid intern for a firm that profits from your loss. Let that sink in. The funded account is a ghost. You trade, they copy the good ones and keep the fees. They call it democratic finance. I call it a systematic extraction of wealth. If you were really a threat, they'd hire you. They wouldn't charge you for a desk. The machine is hungry. It needs fresh capital. It needs fresh, delusional traders. You aren't fighting the market. You're fighting an algorithm designed to stop you out. It's not bad luck. It's physics. The physics of a rigged board. But there is a way out. A way to stop being the fuel and start being the architect. You have to stop playing their game to win yours. Step 1, wake up. Step 2, build your own machine. Welcome to DollarMechanics.
Welcome to the math. Most traders think they fail because of bad luck. They're wrong. They fail because of physics. The physics of gambler's ruin. If you have finite capital and a non-positive edge, your bankruptcy is a statistical certainty. Think of a roulette wheel. You bet on black. 47% chance to win, 53% for the house. Short term, you might win. You might feel like a genius. But the longer you play, the more the 53% grinds you down to zero. Always. Prop firms don't need to cheat. They just need to give you enough time to fail. And then they add the leash, the drawdown limit. A 100K account? No. If your drawdown limit is 5K, you only have a 5K account. They charge you for 100K, but they leverage you into a corner where one mistake kills you. The math is rigged. You need high returns with tiny risk. That's a paradox. One spike in volatility, one news event, the spread widens and you're stopped out. The house keeps the fee, you keep the stress, and the reset button is right there. Let's talk about the 7% who pass, the elite. Their average return is 4%. 4% return on a stressful, high-leverage simulation. Let that sink in. In the US, a 10-year treasury bond pays you almost the same for doing nothing. Zero risk, zero stress, zero fees. Tax-favorable treatment, no hair loss. So why sweat over a prop desk for 14 hours a day to match the risk-free rate? Because the firms sell the dream of leverage, the buying power of 100K. But leverage is a double-edged sword that usually cuts the trader's throat first. The firms know the data. They know your psychology is your biggest enemy. They wait for the revenge trade, the moment you try to win back a loss. The moment you increase your lot size is the moment the gambler's ruin accelerates. You're not fighting the market, you're fighting your own biology. And the firm is the house. They just sit back and collect the participation tax. They love the 7% winners. They are the best marketing money can't buy. They show you the one guy who made 50K. They don't show you the 93,000 who lost $500. It's a volume business. Scale is their edge. Your desperation is their profit margin. Prop firms are basically casinos with Bloomberg terminals. They don't care if you're good, they just care if you try. If you were really an elite trader, you wouldn't be paying a $500 fee to prove it. Real firms provide capital because of your track record, not your credit card. Stop being a customer of a dream factory. Start being a builder of real assets. The transition from trader to architect begins with a single realization. The machine you're trying to beat was built to beat you. You can't win a rigged game. You can only refuse to play. It's time to move from the input to the architect. Act 3, the escape. Welcome to the real machine.
The exit isn't a trade. It's a mindset shift. You stop being the gambler. You realize that $500 challenge fee could have been your first real brick. In the real world, wealth isn't a simulation. It's built on ownership. Stop chasing leverage you don't control. Start building equity you can't lose. Level 1 of the architect, the S&P 500, the engine of the American economy. You buy the top 500 companies. They work for you. No drawdown limits, no resets. You sleep and the machine grows. That is the definition of a dollar mechanic. Level 2, cash flow. Assets that pay you to own them. Dividend stocks, real estate, private equity. These are the tools of the 1%. They don't pay challenge fees. They collect management fees. Think about the logic. Why trade for a firm when you can be the firm? It starts small, a single share, a single bond, a single decision to quit the casino. The math of wealth is simple. Time plus capital plus compounding. The prop firms steal your time and your capital. They kill the compounding. But as an architect, you protect these 3 variables at all costs. You move from high-frequency stress to low-frequency power. You stop checking charts every 5 minutes. You check your net worth every quarter. The peace of mind is your first real dividend. You aren't fighting an algorithm. You are riding the wave of human innovation. This is DollarMechanics. We don't trade, we engineer. If you have $500, don't give it to a prop firm. Give it to your future self. Buy a piece of the world, not a ticket to a simulation. The transition will be slow. It won't have the flashy TikTok dopamine, but in 5 years, while the traders are still resetting, you will be building your second empire. The choice is yours. Be the fuel or be the architect. The prop firms are counting on your greed. I'm counting on your intelligence. The math doesn't lie, only the marketers do. Subscribe to the blueprint. We're building a room full of architects. No flashy courses, no get-rich-quick signals, just cold, hard mechanics. Welcome to the real game, the one where you actually own the board. We are DollarMechanics, and we are just getting started. End of Act 3, the beginning of your architecture. Don't sell your life, build a machine. Subscribe for the next deep dive. We're tearing down the illusion one layer at a time. DollarMechanics, the engineering of wealth.